Because what has happened is, because the volume is bigger than the space that is available, it puts a lot of stress on the equipment. Because normally the equipment are designed to be operated within areas that have minimum aisle width and maneuvering area. But because of the congestion, the containers are stacked so close to each other that the equipment is having some difficulty when it's maneuvering, and this puts pressure on the equipment. Usually there's this public outcry that there's lack of sufficient equipment in the port. That is not the case. It's just that there's increased wear and tear on the equipment because of the extra pressure that is put on them. So we are bound to be investing in additional procurement of additional equipment just to match up with the demand. And on page 40 also, that's what is being referred to as the fourth Banjul Port Expansion Project, because this is the fourth series of the port expansion projects, coming from the first expansion. That was when the port was just established in 1972, and then in the mid-90s there was the second, and then in early 2000 there was the third, and we're now 2022 in the fourth series of the port expansion project. On page 41, these are continuous maintenance projects that we do during our recurrent budget, and these are to do with the terminal areas to repair the drains and some of the pavement on the area, and the provisions in terms of the Dalasi amounts are put in the budget to cater for these repair needs. On page 40 also, we look at the port throughput analysis in more detail. As I had mentioned earlier, the growth in the volume by 6%, and the figures are explained in more detail when you look at the subsequent pages to give the proper breakdown. And it looks at the trend from 2015 to 2020 so that readers can see what the evolution is in terms of both for imports, for exports, by type of cargo, and specifically for containers, which is the main line of business for the port, and also on the number of vessels that are calling at the port, and also statistics about the net and gross registered tonnage, which is through those pages 42 up to page 46. In terms of handling performance, we have benchmarks in the port, and usually we categorize the cargo with containers, general cargo, and then bulk. And for each category, there are some specific targets in terms of handling rate. And what is reported here is that in 2018, 19, and 20, in terms of comparison, the container moves that we were able to handle per hour has been dropping, and it's all as a result of the congestion, because the congestion has it's a ripple effect. If one area is blocked, it affects the other business flows, because the port handling system is like a business flow process. Anywhere there is a weakness in any part of the chain, it affects the whole flow. But generally on general cargo, we've been quite constant in terms of the standard that is expected in terms of the tonnage, and that's 45 tons for every gang hour. And for bulk cargo, in terms of metric tons, it has seen an increase from 2018 to 2020 over the past 3-year period that has been compared. And the breakdown is also given for the export in terms of commodity, and also the destination for transit, as can be seen on page 40, which shows the main transit destination of goods that are coming through to Banjul. Overall, it represents just about 16% of our cargo goes to third countries by way of transit. On the financial review, I would, with the permission of the chair and the honorable members, maybe kindly invite the Director of Finance to go through the statement of financial position of the GPA for that year. And we will refer to the respective pages, if acceptable to the honorable committee.
Thank you so much, Mr. Jobate. I think we can allow the Finance Director to take us through the financial statement.
Hello, good afternoon, everyone. I hereby present the financial statement for GPA for the year 2020. We start with the assets, the non-current assets.
Can you quote the page?
Page 12. Page 12, the non-current assets for 2020. You have property, plant, and equipment, 194 billion 815.
Are you there?
Proceed.
Are you there? Huh? I'm not there. You're not there. Page 12. Okay. You can proceed now.
The non-current asset, the total non-current assets increased from 2,194,982 to 2,119,658 in 2020. The current assets increased from 2,034,278 in 2019 to 2,433,650. That's the total current assets. The total assets for the GPA increased from 4,226,116 to 4,553,000,000 to 4,553,308 in from 2019 to 2020. The equity and liability. The total equity increased from 3,206,513 in 2019 to 3,492,097. The non-current liabilities, that is borrowing, due after 1 year, increased from 483,804 to 337,868. The current liabilities, the total current liabilities increased from 535,843 in 2019 to 723,343 in 2020. The total equity and liabilities for the GPA increased from 2019 from 4,226,160 to 4,553,308. That is the position of the statement of financial position. The next page, page 13, the statement of profit or loss. The revenue increased from 1,759,108 to in 2019 to 1,871,274 in 2020. The cost of sales increased from 242,500,000 in 2019 to 271,391 in 2022. Negative, yeah. So the gross profit for the period under review decreased from 1,516,608 in 2019 to 1,599,883 in 2020. Operating expenses, admin and staff expenses. Admin and staff expenses increased from 584,619 in 2019 to to 519,312 in 591,312 in 2020. That's negative, which means it's an expense. Depreciation charge. Depreciation charge increased from 146,621 in 2020 in 2019 to 154,941 in 2020. Net operating income, other operating income, increased from 23,357,000 in 2019 to 36,701 in 2020. Our operating profit decreased from 809,725 in 2019 to it increased from 808 million in 2019, 725 in 2019 to 890,331 in 2020. You go to the profit before tax. Oh, okay. Let's go to interest receivable and similar income. Note 6.
Can I observe this thing?
Okay.
You know, you have skipped the other one, the net operating expenses.
Net operating expenses.
Those in the negative column.
Yeah.
And that has been skipped, and you are reporting operating profit.
Okay. The net operating expenses increased from 707,883 to 709,552 in 2020 from 2019. Interest receivable and similar income. Interest receivable for the period under review in 2019 we have 11,694,000 to it increased to 33,003,000. Interest payable and similar charges. Interest payable and similar charges increased from 19,897,000 to 22,493,000.
You mentioned the negative, huh?
Negative.
Yeah, negative 19,897,000. You put the negative, huh?
Okay.
Let's have the actual report.
Okay. It increased from 19,897,000 minus to 22,493,000 negative in 2020. Foreign currency translation. The foreign currency translation increased in 2019 from 31,511,000 to 53,412,000 million in 2020. Impairment. The impairment for the period under review, increased from 455,549 million negative to 202,668 million negative. Waivers and rebates. There was none in 2019, and it became 1,334,456 in 2020.
Is it 334 million or 1 million?
134,456 negative. Profit before tax. The profit before tax for the period under review increased from 2019 as 376,484 to 617,128 in 2020. Tax charge for the year. The tax charge for the year in 2019 increased from 166,854 to 236,544. Our net profit for the year increased from 209,630 in 2019 positive to 380,584 in 2020. The statement of cash flow.
Yes.
Our operating profit increased as alluded to in the financial statement. It increased from 808,725,000 in 2019 to 890,331. 890,331,000. The adjustment for depreciation. In 2019, it was 146,621 to 154,941 in 2020. Interest income. Interest income increased in 2019 from 22,086,000 to 40,751,000 in 2020. Loss on disposal of fixed assets. The loss on disposal fixed asset, no, interest income, sorry. Did I make mention of interest income? Yeah. Going to the next one. Loss on disposal of fixed asset. In 2019, it was 7,725,000, and there was none in 2020. Waivers and rebates granted. In 2019, there was nil, and in 2020, it was 134,456,000. Our operating profit before working capital changes as follows. 1,057,058,000 in 2019, and it decreased to 984,570,000 in 2020. The increase or decrease in inventory. In 2019, it was 9,826,000 positive, and in 2020, it became 27,292,000 negative. Increase in receivable. Receivable decreased from 270,412,000 in 2019 to 154,440,000 in 2020. Decrease in payables. Payables in 2019 was 87,086,000 to 150,319,000. Cash generated from our operations in 2019, it was 883,558,000, and increased to 952,156,000 in 2020. Cash generated from operations. Income tax paid. We paid 130,027,000 in 2019. In 2020, it increased to 180,946,000. Our net cash generated from operational activities. In 2019, it was 753,531 to 753,531 to 771,210. Cash from our investing activities. The purchase of property, plant, and equipment. It increased from 92,092,000 negative in 2019 to 166,936,000 negative in 2020. Dividend income. Dividend income in 2019 was 3,793,000, and there was nil in 2020. Disposal proceeds, 2,289,000 in 2019, there was none in 2020. Acquisition, increase of equity and investment. It was 80 million negative in 2019. there is none in 2020. Repayment from ferries. The repayment from ferries in 2019 was 30 million, and there is none in 2020. Net cash used by investing activities is increased from 56,090,000 negative to 166,936,000 positive negative in 2020. Cash flows from financing activities. Borrowings. Borrowings increased from 218,685,000 negative to 164,352,000 negative in 2020. Loans repaid. Loans repaid increased. Loan repaid was 20,473,000 in 2019, negative to 9,834,000 in 2020, negative. Proposed dividend. In 2019, we proposed 50 million negative to 95 million in 2020. Net cash flows from financial activities in 2019, 279,158,000 to negative to 269,186,000 negative in 2020. Net decrease in cash and cash equivalent. In 2019, 418,283,000 positive to 335,089,000 in 2020 positive. Cash and cash equivalent at the beginning of the year was, in 2019, we have 912,032,000 positive to 1,330,315,000 in 2020 positive. Cash and cash equivalent at the end of the year, at the end of 2019, it was 1,330,315,000 to 1 billion positive to 1,165,404 in 2020. That's all. Thank you.
Thank you so much. Can we move to the audit opinion and management letter?
Honorable Chair, members of the committee, subject matter specialist, and director of GPA. May I please refer you to page 8 of the Gambia Ports Authority Annual Report and Financial Statements for the year ended 31st December 2020. Honorable Chair, with your permission, we'll read the summarized
version. Are we all
version.
there? Page 8? The same document, page 8.
I have a different one.
You may go ahead.
Okay. Independent Auditor's Report to the members of the Gambia Ports Authority, GPA. Adverse opinion. We have audited the financial statements of the Gambia Ports Authority, GPA, set out on pages 12 to 34, which comprise the statement of financial position as at 31st December 2020, the statement of profit or loss, the statement of changes in equity, and the statement of cash flows for the year then ended, and notes to the financial statements, including a summary of significant accounting policies. In our opinion, because of the significance of the matter discussed in the basis for adverse opinion section of our report, the accompanying financial statements do not give a true and fair view of the financial position of the authority as at 31st December 2020, and of its financial performance and its cash flows for the year then ended in accordance with generally accepted accounting principles, GAAP, and in the manner required by the Ports Act 1972 and the Companies Act 2013. Basis for adverse opinion. Non-recognition of investments in the Gambia Ferry Service Company Limited and the Banjul Shipyard Limited, and non-consolidation of the Gambia Ferry Service Company Limited and the Banjul Shipyard Limited. The Gambia Ferry Services Company Limited Ferries carries out the business of ferry services, carriers of goods and passengers, etc. in the Gambia. The Gambia Ports Authority has significant, i.e. 80% equity interest in ferries valued at $40 million as noted in the Memorandum of Association dated 21st of April 2001. We noted that GPA has been taking care of most of the operational expenses of ferries, and the Deputy Managing Director of Ferries reports to the Managing Director of GPA. The Banjul Shipyard Limited, Banjul Shipyard, mainly carries out the business of slipping and dry docking for repairs and maintenance of sea vessels, etc. The GPA owns 99% of the equity of the Banjul Shipyard, valued at $9.9 million, as noted from the Memorandum of Association dated 2nd January 2001. We noted that GPA funds the operational expenses of Banjul Shipyard, and the General Manager of Banjul Shipyard reports to the Managing Director of GPA. The above facts indicate that the Gambia Ports Authority has a controlling interest in Gambia Ferry Service Company Limited and Banjul Shipyard Company Limited. In respect of generally accepted accounting principles, the Gambia Ports Authority has the practical ability of control over Gambia and Banjul Shipyard Company Limited, and therefore should recognize the investments and consolidate the financial statements of both companies. However, the Gambia Ports Authority failed to recognize the investments in Gambia Ferry Service Company Limited and Banjul Shipyard Company Limited as of 31st December 2020, or consolidate the financial statements of both companies. Had the Gambia Ports Authority been consolidated, many elements in the accompanying financial statements would have been materially affected, and therefore the departure from the requirements of generally accepted accounting principles, i.e. FRS 102 Section 9, are considered to be pervasive. The effects of the consolidated financial statement of this departure have not been determined. The financial statements are, the audit opinion is signed on page 11 by DT Associates, Chartered Accountants, Registered Auditors, Ajipenda Sankare Partner, dated 12th of April 2022.
Can we move to the management
opinion.
level? Yeah.
So the management level.
Yeah. Only the adverse audit findings. Only the adverse audit
High
findings that
risk.
are high risk.
High
Yes.
risk, okay. The first high risk is 2.2, page 7. Dock workers. Hello. As noted in prior year's report, we observed that payments were done through cash. We are concerned with the high volume of cash transactions and associated risk of fraud and theft. 2.2.2, no documented policy or procedure on dock workers' loan. During our review of the authority's staff and other loans, we noted that there was no documented policy on granting of dock workers' loan. Although management confirmed that dock workers obtain and fill loan forms which are evaluated by the Finance Department before approval of the Managing Director, there was no formalized or documented policies and procedures for the application process and evaluation criteria prior to approval. We also requested for a sample of approved loan application forms for dock workers detailed in the table below. However, these were not provided for our review. 2.2.3, no collateral on dock workers' loan. We also noted that dock workers make loan applications to the authority through their union. The union presents a proposal to GPA management listing members with the respective loan amounts requested. According to management, loans are granted after evaluation, but no collateral is provided by the members of the union. Implication: the absence of a well-defined loan policy on dock workers results in weak controls and ineffective supervision by management. In the absence of relevant controls relating to granting of loans, the risk of default and potential financial losses is increased. The absence of supporting documents for loans granted increases the risk of fraud and misstatements. Facilities granted to dock workers without adequate securities could increase the authority's exposure to credit risk and associated financial losses. Can I skip the recommendation? Should I continue? Page 10, staff loan, 2.4. Of the authority's staff loans, we observe that the authority has a 9-month recovery period in its loan policy guidelines. However, during our test of repayments, we noted that loans granted to staff were recovered for only 5 months during the year instead of 9 months as per the policy. There was no evidence of deduction or recovery for the rest of the 4 months. We were not provided with evidence of approved repayment holidays granted to the staff. Furthermore, there was no documented policy on loan repayment suspension or holidays. Neither was such included in the loan agreement with staff, nor factored during evaluation to ascertain a more factual repayment timeline. Staff loans were paid. Internal audit report. As part of our audit, we reviewed the internal audit report and carried out further audit tests on key findings that were noted in the internal audit report, which also featured in our risk assessment as detailed further below. 3.1 Procurement issues. According to the report, there were 2 high-value procurements in the risk assessment matrix with issues as detailed below. During the period under review, there was a purchase of mobile phones for management amounting to $1.9 million as detailed below. These are smartphones in the table. This procurement was not justified as there was no budget line for the expenditure or approval from the board. Management did not provide the list of beneficiaries to confirm who received the mobile phones. As highlighted in our prior year management letter on the similar observations, we have not been provided with any documentary evidence that permits the authority to pay such incentive to the aforementioned beneficiaries. And 2, an instance was noted for the purchase of corporate items amounting to $481,250, where only one supplier responded to the request for bids. The internal audit department suggested for more quotations to be obtained. However, this was not done. In line with the Gambia Public Procurement Act Regulations 2019, that states for purchases of goods up to 20,000, approval should be sought for single sourcing by the purchasing party. Implication: the absence of the necessary approvals, documented policy, and supporting schedules on these incentives could increase the risk of unnecessary and invalid spending by the authority. Lack of adherence to the procurement method for the set thresholds is a non-compliance with the GPPA Act. Acquisitions from one supplier in the event others do not send in quotations and no follow-up from the procurement department creates room for fraudulent activities such as favoritism of certain suppliers for kickbacks by requesting for quotations from others that would not respond. 4.2 confirmed payable balances. We also noted a difference between amounts confirmed by suppliers and the amounts recorded in the general ledger for the payables below. The implications, the difference noted between the general ledger and the confirmed balance indicate that the payable balance reported in the financial statement should be restated, and frequent reconciliations are not carried out by the authority. Page 22, loans 4.3. From a review of the authority's loans outstanding as at the end of the period under review, we noted the following. ADB loan reported in the financial statement is a balance of 248.5 million relating to loan payable to ADB as at 31st December 2020. As per the repayment period stated in the agreement provided for our review, this loan should have been fully repaid as at December 2017. A revised agreement with the borrower was not provided for our review, and we therefore could not confirm the completeness and valuation of the loan balance. Furthermore, we noted a difference of 2,507,217 between the amount confirmed by Ministry of Finance and Economic Affairs and the amount recorded in the general ledger for the loan balance as detailed below. 4.3. Diamond Kunkujeri loan. We noted that the authority did not recognize interest expense on the Diamond Kunkujeri loan amounting to 8.4 million. Diamond Kunta Kinte loan. We also noted that the authority did not recognize interest expense on the Diamond Kunta Kinte loan amounting to 10.3 million. The differences noted between the general ledger and the confirmed balance indicate that the loan balance reported in the financial statement could be misstated, and frequent reconciliations are not carried out by the authority. Omission of expected interest expenses on these loan balances could misstate the profit and payable balances reported on the financial statements. Page 24, revenue. Accounting for rebates. During our review of the authority's revenue general ledger for 2020, we noted debits amounting to 5 million relating to rebates granted to customers on throughput. These are deducted from revenue instead of separately being accounted for as discount allowed. Furthermore, we were not provided with the list of customers that benefited from these discounts or the evidence of approvals for the discounts. The table below has the details. And then waivers, we also noted debit transactions in the revenue ledger amounting to 129 million relating to waivers granted on various cargo handling charges for the period under review as detailed below. These are also recognized within revenue instead of separately being accounted for as discount allowed. We are yet to obtain evidence of both approval and justification for the rebates. Furthermore, for some of the above listed customers, as noted in 4.5.2 above, the confirmed balances were lower than what was recorded in the books of the authority, implying that the waivers may not have been accounted for appropriately. Implication: waivers and rebates granted to customers may not be completely and appropriately accounted, resulting in misstatement of revenue and receivable balances reported in the financial statements. The absence of a board and relevant authority approvals implied that management is making decisions without the approval of the board of directors, who have fiduciary duty to represent and protect the authority's finances, resulting in loss of total revenue by 129.3 million. With your permission, my colleague will assist me. Just look for the high risk. The next one is big.
Good afternoon. With your permission, I will continue on page 28, 4.6, impaired. Page 28, 4.6, impaired assets. The internal audit team carried out a physical verification of the authority's fixed assets and noted assets that had been demolished or not operational. we confirmed that these impaired assets had carrying values amounting to $6.9 million, and impairment charges were not made. The value of these assets in the register are detailed below. Implication: the non-recognition of impairment on these assets means that the fixed asset balances recorded in the financial statements are overstated. On page 30, 4.7, equity investments. During our review of the authority's equity investment, we noted the following exception. A Trust Bank Limited investment. We noted a difference of 5.8 million between the expected value of the Trust Bank equity investment and the general ledger, as detailed below in the table. For the listed below in the table. 5.1.2 receivable confirmation. As part of the audit procedures, we sent confirmation to a sample of the authority's receivables to confirm the value of these balances as at the end of the period under review. However, we are yet to receive the receivable confirmations for the listed below. 5.1.3 equity confirmations. As part of our procedures, we sent confirmation to all investees to confirm values of shares held by the authority as at the end of the period under review. We are yet to receive the equity confirmation for the listed below. The implication: the absence of the pending confirmation replies limits our audit work, as we could not confirm the valuation of the balances noted below. On page 24, prior year management letter points. 6.1. 34. Yes. Okay. 6.1, risk management. Risk management is an integral part of any entity and is required to ensure that any potential threats to the entity's success are identified and dealt with effectively and on a timely manner. We noted with concern that the authority does not have a risk management unit or process in place. This has not been implemented. Page 35, 6.2.2, Board Audit Committee. Committee meetings. During our review, control committee meetings. During our review around the authorities' control